Earnings season is upon us, which means we could see a return of volatility. The earnings season allows us as investors to get a sneak peek into how companies have been performing, but at the same time, it also gives management an opportunity to upgrade or even downgrade their full year guidance. And as such, with that volatility, I'm looking for opportunities. So in today's video, I'm going to be telling you about 3 stocks that I've been buying the dip on. Each of these 3 stocks have dropped more than 10% in recent months. So we'll be detailing all of these out in this video today. But before I unveil them, do me a huge favor. Simply click that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump straight into our list, beginning with stock number 1, which is going to be ASML Holdings, stock ticker ASML. And when it comes to this company, they are the premier manufacturer of these lithography machines. These are key machines that are used to build today's powerful and high-speed AI chips. And in case you've been living under a rock over the past few years, chip demand is through the roof. I often get the question, Mark, are we in an AI bubble? And it's a fair question, considering we've ridden the backs of AI companies for the past 2.5 years in the stock market. But my answer is always pointing them towards the results. Let the results speak for themselves. Companies continue to design, companies continue to manufacture, and CapEx budgets continue to climb higher. Companies continue to spend. Alphabet just reported their latest earnings results, and in those numbers, they increased their annual CapEx budget from $75 billion up to $85 billion. And we're going to get a number of updates around CapEx spending with other mega cap companies in the weeks ahead. So getting back to ASML, the company recently reported their latest earnings results, which actually beat on both the top and bottom lines, better than expectations. Revenues came in at $8.95 billion. Net profits came in at 2.29 euros versus an estimate of just 2.04. However, the day after reporting, the stock fell 10%. And since then, shares are still down 11.5%. And again, this gets back to my popular saying, it's less about what you did for me and more about what you're going to do for me. The results beat analyst expectations. It was a guidance issue. Popular investing firm Evercore ISI came out with a note saying the drop in ASML shares is a buying opportunity. And I tend to agree. And I put my money where my mouth is because, as you can see, I put out a trade alert to all of my Edge Plus subscribers, notifying them that I was buying the stock on the day it dropped. Why did I do this? I believe this is a great company with a great balance sheet. They are showing growth, higher margins, and a wide moat. Looking at this chart I put together with Fiscal.ai, and again, if you're not using Fiscal.ai to perform your research on stocks, I don't know what you're waiting for because the ease of use and information is endless, and it makes my job of research so much easier. You could try it out for free by utilizing my link down in the description below. But what you can see here is not only revenue growth that has increased from $6.8 billion 10 years ago to nearly $38 billion over the trailing 12 months. You also see the EBITDA numbers, which are in orange. They have grown from $2.4 billion 10 years ago to $14.2 billion again over the trailing 12 months. And finally, operating margins, which are sitting at an impressive 34.8%, just shy of the record highs the company saw in 2021 during the pandemic. Looking forward, a way to judge demand is by looking at their net bookings, as these are orders that have been placed but not yet fulfilled by the company. And net bookings came in at $5.5 billion. And analysts were only looking for $4.2 billion. Again, those are in euros. So that was another very positive sign. The biggest culprit for the stock decline was management updating their forward guidance. Remember, it's more about what's to come. And the forward guidance used to be looking for 30% growth, and management cut that into 15% growth looking ahead. A lot of that has to do with the geopolitical concerns and the uncertainty in the macro ahead. I just think it's ASML being a little conservative, something they've done in the past. And what do they do at the same time? They have increased their stock buybacks. From a valuation perspective, shares look rather cheap after this dip, as you can pick up shares at a forward PE multiple at 26.7 times, well below the company's 5-year average of 34.4 times. From an EV to EBITDA perspective, shares trade at just 26.7 times, again, well below their 5-year average of 33.1 times. This is a great opportunity to add a high-quality name at a great valuation. And now we're going to move on to stock number 2, which is going to be SentinelOne, stock ticker S. And when we talk about SentinelOne, we're completely changing gears here from AI over to cybersecurity. And those two themes right there are my two major focuses in my account moving forward. And if you're part of my Edge Plus subscription, you recently got a notification that I started a position in SentinelOne. SentinelOne is a cybersecurity firm that has been in the news of late, as fellow cyber giant Palo Alto Networks has been lurking regarding a potential acquisition. Right now, the reports are not confirmed, so it's only speculation. So when it comes to me buying, there's really two major reasons. The first is that arbitrage. If Palo Alto decides to step in right here, this is going to be shares that are moving up from $19 up to $25 or $30 range in terms of a acquisition price. That could be huge gains in a rather short period of time. The other reason is this is a cheap way to enter into and gain some cybersecurity exposure. I already have exposure through the likes of a CrowdStrike, but again, a major theme for me looking to add to my exposure. SentinelOne has a $6.5 billion market cap, and over the past 12 months, shares have fallen more than 15%. But shares are also trading 50% below their 52-week high, which was reached back in December of last year. SentinelOne is still a very young company, having only been founded in 2013 and went public in 2021. As you can see here from this Fiscal.ai chart, revenues have been growing at a strong clip, going from $46.5 million in sales in 2019 to $864.1 million in sales over the past 12 months. So still very young, but it's looking to reach positivity in terms of margins and profitability. For cyber companies, one of the best ways to forecast growth is to look at RPOs, or remaining performance obligations. These are orders received, but the company still needs to perform the task. And over the past 12 months, RPOs are sitting at an all-time high for SentinelOne of $1.16 billion. So the growth is there. In terms of valuation, again, this is a company that's not yet profitable, so we can't rely on earnings multiples. As such, we'll stick with price to sales. SentinelOne currently trades at a forward price to sales of 6.1 times, which is well below the company's 3-year average of 7.6 times, sitting near the lowest in the company's history, yet demand is at an all-time high. This is a dip that I'm buying at a great valuation while also increasing my cybersecurity exposure. Before we jump to the next stock, let me quickly tell you about a 3-day option workshop event that I have coming up July 29th to July 31st. If you're brand new to options or you've just been trading options for a few days, this is an event for you to attend. We will be joining for roughly an hour each of the 3 days. Again, July 29th to July 31st. Make sure you save your seat because this event does in fact sell out. Check out the link down in the description below. And that's going to lead us to stock number 3, which is going to be Lockheed Martin, stock ticker LMT. And when it comes to Lockheed Martin, they've been a key clog within the defense contractor space. But what have they been doing? They've been lagging that space and their competitors. Over the past 12 months, here's a look at the returns for the likes of Lockheed Martin, RTX, General Dynamics, and Northrop. RTX has led the way at a plus 37% return over the past 12 months, Northrop over 20%, General Dynamics up 8%, and LMT is the only defense contractor in the red over the past 12 months with a return of negative 19%. These are stocks that really trade in tandem. They don't get that separated all that much. When it comes to Lockheed, they are an industrial juggernaut with a market cap of $98 billion. And in the latest quarterly results, which is what sent the stock tumbling in the recent week, the company had a $1.8 billion write-down that negatively impacted profits. The transaction was a classified government order that was altered. In addition, the company trimmed their full-year profit guidance by 15%, which was entirely related to the write-down they incurred during the latest quarter. In terms of operating results, the company continues to drive revenue growth. As we could see, they are sitting at all-time highs. but pressures from the government cuts and such has weighed on profit margins, which is where the concern has been. However, it seems as if management could turn things around with more U.S. allies putting in orders to bolster their defense units, which could be more profitable for the business. Definitely something to watch in the coming quarters. When it comes to looking at demand for a company like Lockheed, remember, for SentinelOne, we looked at things like RPOs. But Lockheed, we want to focus on what's called backlog. These are orders that have been placed with the company, but not yet fulfilled. This can give us a look into demand for companies' products. And as you can see on this fiscal.ai chart, demand is still quite strong, with the backlog sitting near record highs at $166.5 billion. From a valuation perspective, shares are looking rather cheap after the sell-off in the stock. They trade at a forward PE multiple of 15.4 times, and we are comparing this to a 10-year average of 17.3 times. EV to EBITDA sits at 11 times flat. This is again below their 10-year average of 12.3 times. And I decided to use the longer duration averages as it tends to be more conservative, and we can see even with those shares, they still look cheap. So again, with Lockheed here, they're not going to knock your socks off in terms of growth, but they do pay a dividend, and you're getting a high-quality company, a great management team at a great price, and that's what we're constantly trying to do as investors. So there we just looked at 3 stocks that I'm buying the dip on. All of them have had rough patches here, and I believe their futures are still quite bright. We have some fast growers, we have some dividend payers. Choose what's best for you. And let me know down in the comment section, which of these 3 stocks would you most likely buy and add to your portfolio? And again, if you haven't done so, make sure you smash that like button down below as it really helps the growth of this channel. I truly appreciate it. Make sure you're subscribed, and we'll see you in the next one. Take care.